As of this moment, with the market live and trading, UnitedHealth Group, ticker UNH, is trading at $371.72. That's a solid intraday gain of $5.74, or about 1.57% on the day. Now, most people checking their Fidelity mobile app or Robinhood app see that green number next to UNH and think, good, the big safe healthcare stock is doing what it's supposed to do. The common expectation is that UnitedHealth is just a boring insurance utility, a blue-chip anchor for a retirement account. But that expectation is completely missing the real story. The 1.5% move you're seeing today isn't just market noise, it's the latest twitch in a company that is having a full-blown identity crisis. The reality is, UnitedHealth isn't one company. It's a high-growth, data-driven technology and services company, Optum, that is financially shackled to a highly regulated, politically vulnerable insurance utility, UnitedHealthcare. The entire battle for this stock's future, and the reason for its intense volatility this year, is the market trying to decide which of those two businesses will define its future. It's easy to see why investors get confused. For the better part of a decade, UNH was the ultimate set-it-and-forget-it investment. You bought it, you put it in your Fidelity IRAs, or had it as a top holding in Schwab Intelligent Portfolios, and you just watched it compound. It was the definition of a stable, long-term holding. But the reality of the last 18 months has shattered that belief. This safe stock has been incredibly volatile, trading in a massive, frustrating range. We saw it collapse to 52-week lows near $350 just last month, a level that panicked many long-term holders. That's not the behavior of a simple utility. That is the behavior of a company facing a fundamental challenge to its business model, and the daily swings, including the one today, reflect that deep uncertainty. Let's look at what's driving the recent action. The trading volume today is actually fairly standard, but the type of activity is what's telling. We're seeing significant block trades, which tells me large institutions are likely repositioning, perhaps deciding that the recent dip was overdone. At the same time, platforms geared towards self-investing, like Robinhood or SoFi Invest, are almost certainly seeing a wave of retail buy-the-dip activity. Meanwhile, the more sophisticated traders using platforms like interactive brokers are probably not just buying the stock. They're in the options market, placing bets on whether the upcoming regulatory news will be a catastrophe or a relief. This isn't a simple stock go up story, it's a battleground. The recent Q3 earnings report was a perfect microcosm of this split personality. On the surface, the numbers were good. UNH beat analyst expectations on both revenue and earnings per share. And the star of the show, as it has been for years, was Optum. The Optum segment, which provides data analytics, pharmacy benefit management, and direct healthcare services, is a machine. Optum Health revenue was up strong. Optum Rx continues to dominate. This is the part of the business that makes Wall Street analysts argue UNH is a tech company in disguise. It's growing fast, it has high margins, and it's what differentiates UNH from its peers. But here is the reality check that the earnings report also delivered. While Optum was soaring, the legacy UnitedHealthcare insurance business was flashing warning signs. The key metric we all watch is the medical loss ratio, or MLR. This is simply the percentage of premiums that the company spends on actual medical care. For a while, during the pandemic, this ratio was artificially low because people were avoiding the doctor. Now, the floodgates have opened. Seniors in particular are rushing back to get procedures they put off: knee replacements, hip replacements, cardiac care. This trend, which spiked in Q2, remained elevated in Q3. The expectation was that these costs would normalize. The reality, they are staying stubbornly high, and that puts a direct squeeze on the insurance segment's profitability. This flows directly into the 800-pound gorilla in the room, the single biggest threat to this stock, the political and regulatory war on Medicare Advantage. For years, UNH has feasted on the MA program. It's the largest provider of MA plans in the country, and it's been a massive source of growth and profit. That party appears to be ending. The government, through the Centers for Medicare and Medicaid Services, is cracking down. They are tightening reimbursement rates, implementing stricter auditing rules, the RADV audits, and basically signaling that the gravy train is over. The 2025 and 2026 rate notices have been far less generous than the industry hoped. This is a direct frontal assault on UNH's core profit center. The market expectation was that UNH, with its massive lobbying power, could fight this. The reality is that healthcare costs are a populist political issue, and no party wants to be seen as overpaying massive insurance companies. So, that 1.57% pop today? It's the market betting that maybe, just maybe, all of this negative regulatory news is finally priced in. It's a relief bounce, not a fundamental change in the story. This is what makes online investing in a name like this so challenging. You can't just look at the PE ratio, which looks cheap, by the way. You have to understand the intersection of demographics, technology, Optum, and, most importantly, politics. This isn't like buying Nvidia stock, which is a pure, unadulterated bet on AI growth. It's not even like Apple stock, which is a bet on a consumer ecosystem. This is a bet on Washington, D.C. This is why many investors using investing sites or Fidelity ETFs prefer to get their healthcare exposure through a diversified basket, rather than holding an individual brokerage account with all the headaches of a single complex stock like UNH. For anyone who might be new to this name, let's quickly clarify what UnitedHealth Group actually is, because the two sides are so distinct. First, you have UnitedHealthcare. This is the brand you probably know. It's the health insurance arm. They provide employer-sponsored plans, individual plans, and they are the single largest provider of Medicare Advantage plans in the country. They make their profit from the spread, the difference between the premiums they collect and the medical costs they pay out. Then you have Optum. This is the part that Wall Street loves. Optum is the services business. It has three parts: Optum Health, running clinics and employing doctors; Optum Insight, data analytics and tech for hospitals; and Optum Rx, a massive pharmacy benefit manager, or PBM. Optum sells its services to other insurance companies, hospitals, and governments, not just to UnitedHealthcare. It's the high-margin, high-growth engine that's supposed to make UNH different from just being a boring insurer. And there's another shadow complicating this entire picture: the rise of GLP-1 drugs, the popular weight loss medications. The expectation from some market bears is that these drugs will eventually create a healthier population, drastically reducing the need for all kinds of medical care. If obesity, diabetes, and heart disease rates fall, that's fewer procedures, fewer doctor visits, and less demand for the very services UNH provides. This narrative has absolutely hammered stocks in sectors like medical devices. The reality, at least according to UNH management, is far more complex. They argue that in the short term, these drugs are incredibly expensive, driving up pharmacy costs, which Optum Rx manages. But in the long term, they could lower costs in other areas, like cardiac care. The company's view is that this is a net neutral, or perhaps even a net positive, as they are positioned to manage the total cost of care. The market, however, remains skeptical, and it's one more reason this stock has struggled to find a clear direction, unlike the straightforward growth stories of, say, Tesla stock. So, where does this leave investors looking at this $371.72 price tag? What's the path forward? The future outlook depends entirely on which of these realities wins the tug-of-war. Scenario 1 is the bull case. Optum is a tech company. In this version, the market finally agrees to value Optum as a separate, high-growth entity. Its growth, driven by data and services, continues to accelerate, and investors begin to see the insurance side as just a stable, cash flow-generating utility that funds Optum's expansion. If this happens, the stock is cheap and could re-rate significantly higher. Scenario 2 is the bear case, the regulated utility trap. In this reality, the government crackdown on Medicare Advantage is severe and permanent. The high medical cost trends don't go away. The insurance business, which is still the vast majority of revenue, sees its margins squeezed for years to come. Optum's growth is good, but it's not enough to offset the margin compression in the core business. In this world, the stock is a classic value trap. It looks cheap, but its earnings stagnate or decline. This is why using a dedicated Fidelity trading platform or the Interactive Brokers platform is so important for online investing in a complex name like this. You need access to good research and data, not just the basic charts on a simple